Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing NortonLifeLock stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. NortonLifeLock is a cybersecurity software company. It offers security for your digital devices by helping to protect your PCs, Macs, mobile devices, identity, etc. Back in 2015, the company Symantec split into two independent publicly traded companies. One of those companies is Norton and the other is Veritas. They sold Veritas to the Carlyle Group in 2016. The company is headquartered in Tempe, Arizona and was founded in 1982. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Vienna, EuroTLX, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 16 billion market cap. They're trading at $27 a share and they have 582 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in 2019 at 1.3 billion, a big negative in 2020. Then it went back to positive 700 million in 2021, and that grew to nearly 1 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was really big in 2020, close to 4 billion. It's a little over 900 million in the trailing 12 months. Revenue is a sales for the company, and that was really high in 2019. It dropped a lot in 2020. And their revenue has been growing a little bit from 2020 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's 2.3 billion in the trailing 12 months. Below that is their operating expenses. Marketing is their big operating expense. Gross profit minus operating expenses gives you your operating income. Their operating income in the trailing 12 months was almost the sum of 2019 and 2020 combined. They received 1 million of interest on their investments. They paid 130 million of interest on their debt, which is a lot lower than 2019, 2020, or 2021. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When they sell an investment, the profit or loss on that investment goes into this section. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income. And that's a little over 900 million in the trailing 12 months. The reason they had such a big gain in 2020 was from discontinued operations. All dollar amounts in discontinued operations won't appear in subsequent years. You'll see later their employee count went down a lot in 2020. In 2020, the company sold its enterprise security assets to Broadcom. During the time Norton owned that company, their profit in 2020 was 5.4 billion. So in 2020, Norton reports 5.4 billion from that business, but in future years, in 2021 and beyond, that business is part of Broadcom, so Norton receives nothing from it. That's why it's reported in discontinued operations. This is the company's income statement from their annual report. This is the 9 months ending 1/1/21, the 9 months ending 12/31/21, the 3 months ending 1/1/21, and the 3 months ending 12/31/21. Their revenue in the last 3 months of 2021 was 700 million. 490 million of that revenue is in the Americas, 128 million in Europe, Middle East, and Africa, and the APJ countries is 81 million. The big countries in APJ are Hong Kong, India, and Japan. 418 million from consumer security and 284 million from identity and information protection. Consumer security is Norton 360, Norton Security, Norton VPN, Avira Security, and some others. The identity and information protection includes LifeLock offerings and also identity theft. Their cost of revenue is 100 million, so their gross profit is 600 million. Up from 552 million. They have really high gross margins, 85%. That's gross profit over revenue. The average in their industry is 60%, and their net margins are 29%. The average is negative in their industry. Their big operating expenses: marketing $160 million, R&D $60 million, general and administrative $42, amortization $21, and restructuring is $12 million. So their operating income is up from $280 million to $302 million. And their net income is up from $178 million to $202 million. Their earnings per share is up 6 cents from 29 cents to 35 cents. They've decreased their shares outstanding from 593 million to 582 million. It seems like they buy back lots of stock. That's why they have negative equity. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. They generated over $1 billion in the trailing 12 months. They don't spend much in CapEx. In 2019, they spent over $200 million. In the trailing 12 months, only $5 million. Most of the money they spent on CapEx was on the business they sold to Broadcom. Now they're just focused on the software business, so they don't have much CapEx spend. Operating cash flow minus CapEx gives you your free cash flow. They paid down a lot of debt in 2019, 2020, and 2021. They added a little debt in the trailing 12 months, but they buy back a ton of stock: $230 million, $1.6 billion, $300 million, $170 million. Every time a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. This is the company's operating section on their statement of cash flows. And the way you calculate operating cash flow, you start with your net income. That was $716 million. Then we add or subtract the non-cash items on the income statement. We add back $108 million of depreciation and amortization. They had a gain on the sale of property. That was $175 million. We minus that out. This is a cash item, but since it shows up on the investing section, I'll show you that in a little bit, we have to adjust for that here. And that's the main reason their operating cash flow is less than their net income, because of this gain on property. They reported a gain on the income statement, so it brought up their net income, but it's not an operational item, so we minus it out here. This is their revenue and operating cash flow since 2015. Since they sold off parts of their business in 2019, their revenue has come down quite a bit. This orange line is their operating cash flow. They were losing cash flow in 2020, but it looks like things are getting better in 2021. This is their investing and financing sections on their statement of cash flows, and this is the 9 months ending 12/31/21. They received $355 million from the sale of property. The reason the income statement does not say $355 million is because the income statement reports a profit or loss. So if they bought that property for $100 million, they would report a gain of $255 million. Say they bought that property for $455 million, they would report a loss on their income statement of $100 million, even though they received $355 million of cash flow. In their financing section, they paid down $400 million of debt. They added $500 million of debt. They paid out $230 million of dividends. For the 9 months ending 1/1/21, they paid out $300 million of dividends, and they bought back $138 million of stock. This is the equity section on their 12/31 balance sheet. They raised $2 billion from selling their business, and they lost $2 billion from running their business. But they don't report treasury stock as a separate item. Whenever they buy back stock, they reduce their retained earnings. So all the stock buybacks have brought down their equity balance to negative. They are cash flow positive, as we saw, and also their net income is positive, but they bought back so much stock, it brought down their retained earnings. Let's look at the capital structure. They have negative $100 million of equity. That means their liabilities are $100 million more than their assets. And they have $4 billion of debt, so they're 100% debt. Their net debt is $2.2 billion. Net debt is debt minus cash. And I gave them the highest whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $23 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $21 billion. We divide that by 582 million shares. And we get a calculated stock price of $36. They're trading at $27, so they're trading at a 26% discount. It's a buy according to the model. Their revenue is projected to hit $3.2 billion by 2024. And the projection for 2023 is $3 billion, 2022 is $2.8 billion. And I grew their revenue at a similar pace for 2025. That's how I got their future revenue estimates. In 2021 and the trailing 12 months, they converted 31% of their revenue into free cash flow. So I multiplied their future revenue estimates by 31%. That's how I got their future free cash flows. They were a different company before 2021 because they sold off parts of their business to just focus on the Norton brand. The website Simply Wall Street values the company at $54. They're saying it's 51% undervalued. 3 analysts priced this stock and the average price target is $29. This is where the stock has been trading the last 12 months, so it definitely moves around a lot. A year ago it was $20 and it was trading sideways for about 8 months. Then it shot up to over 30, now it's sitting around 27. This blue line is the Norton stock. The red line is the S&P 500, which is up 5%. Norton is up 24%. A couple of their competitors, Cyber, that's up 18%. And Palo Alto Networks is up 71%. They have a pretty good brand name. They have 80 million users and 23 million customers. Because some customers are businesses that have many users inside that business. And you can see their customer count has been going up little by little over the years. It pretty much never decreases quarter over quarter. It either stays flat or increases. I'm a customer of Norton, and the reason I buy their product is to keep my computer safe. And that's exactly what it does. In 2021, it blocked 3.6 billion threats. It also blocked 54 million phishing attempts, 1.4 million malware files. Over 9 million threats are blocked each day. It's kind of like insurance. You hope you don't need it, but when you do need it, you're glad you have it. Their beta is close to 1, so the stock moves with the market. It's gone up 22% in the past 52 weeks, while the S&P is up 5.5%. The 52-week low is 21, the high is 31. And the stock is trading between its 50-day and 200-day moving average. In the past 3 months, about 6 million shares are traded each day. Of the 582 million shares outstanding, 580 million are on float. Almost all the shares are held by institutions, and 80% of the shares are shorted. They do pay a pretty consistent dividend year to year. It's almost 2%. They received a lot of cash when they sold part of their company to Broadcom, and they paid a special dividend. And this could be another reason they have negative equity, the special dividend. The way retained earnings are calculated, you take the sum of all the company's prior net incomes minus the sum of all the dividends they paid out. And like I said earlier, when this company bought back their stock, they just reduced retained earnings instead of posting treasury stock, a contra equity account. This is their dividend since 2013, so it was over 3% back in 2016. Now it's closer to 2%, and the forecast is for their yield to stay around 2% for the next few years. The company did 3 stock splits, all 2-for-1s in 2002, 2003, and 2004. And you can see their employee count has gone down a lot since they sold off part of their businesses. They had 19,000 employees back in 2016, now they're at 2,800. The business they sold off to Broadcom was capital intensive. It required a lot more employees. The Norton part of the business is a lot more scalable. The CEO makes $750,000 a year for his salary, and his total compensation package is $14 million. That would be nice, making $750,000 a year. If you invested $10,000 into this company 10 years ago, you'd be pretty happy at $37,000 today. That's a 14% annual return. There's so much insider buying and selling on this stock. If I showed you each individual insider trade, this video would take over an hour. This is broken down by quarter, so the insider selling, 89 million shares, 82 million shares, 74 million shares, and 13 million shares. The insider buying, 91 million shares, 65 million shares, 88 million shares, and 5 million shares. And most of this activity is by companies. You can see 32 companies in this quarter, 30 in this quarter, 32 in this quarter. 99.7% of the companies held by institutions, 0.3% by individual insiders, and 0.06% by the state or government. The biggest shareholder is Vanguard at 11%, then Capital Research, BlackRock, State Street, and Boston Partners. Let's look at their financial ratios. They have a pretty good PE at 17.0, that's stock price over earnings per share. Better than a market median and average. Their price to sales is 5.6, that's stock price over sales per share. We cannot look at the price to book since they have negative equity. Their price to free cash flow is 15.5. Let's look at their non-current assets. 63 million are property and equipment. The value of the assets they're leasing is 80 million. $1 billion of intangible assets. That $1 billion is $222 million of customer relationships. So when they acquire another company, they have to value the worth of those customers, because those new customers are going to provide future revenue streams. $81 million of developed technology, $6 million of other, and $745 million of trademarks. They have $2.9 billion of goodwill. Goodwill is the premium you pay when you acquire another company. And $643 million of other. That $643 million is $176 million of equity investments. These are their investments in other companies. They're owed $26 million in taxes, $335 million in deferred income taxes. This should help reduce their taxes in the future. They're due $57 million on a royalty payment and $49 million of other. Let's look at their non-current liabilities, $2.8 billion of debt. Here's a breakdown of their debt. $400 million and $625 million are due this year, $1.1 billion due in 2025, and $1.7 billion due in 2026. If they had a majority of their debt due this year, that could be a little concerning. Because if they had a lot of debt due this year, they would have to take on a lot of debt this year to pay down the old debt. And that may scare some investors into selling the stock since they're taking on so much debt. I'm not saying the company would go bankrupt if they had a lot of debt due this year. I'm just saying it looks bad when you take on a lot of debt. And that's what companies usually do to pay down debt. They take on new debt. They just keep rolling the debt. So that's $3.9 billion. $2.8 billion is long term, so it's due beyond 12 months. $1.1 billion is due within 12 months, so we'll see that in the current liability section. They owe $48 million on long-term contracts. They owe $137 million on deferred income tax liabilities. This will increase their taxes in the future. They owe $1 billion on income taxes payable. That $1 billion is $438 million of repatriation and $571 million of interest and penalties. The US government is really trying to crack down on companies reporting income overseas so they save on taxes. Some companies report income in Ireland or Bermuda because they have really low tax rates. But when the US government figures that out, they repatriate the money back to the US and forcing Norton to pay taxes using the US tax rates and paying taxes to the US government, not to other countries' governments. And they owe $81 million on the assets they're leasing. We saw the value of those assets when we looked at the non-current asset section, and $53 million of other. They have a really high return on invested capital of 46%. The reason it's so high is because the denominator is equity plus net debt, and their equity is negative. Their interest coverage ratio is above 9. We cannot look at their ROE since they have negative equity. They can only cover 70% of their current liabilities with their current assets. Same thing with the quick ratio since they have no inventory. Let's look at their current assets. $1.8 billion of cash, $10 million of short-term investments, $113 million of receivables. This is how much money their customers owe them. $205 million of other current assets, and $58 million of assets held for sale. When a company has an asset held for sale, like a building, that asset is no longer depreciated. It sits at its current cost on the balance sheet until it's sold. And it's always reported in the balance sheet at the lower of carrying value and fair value. Carrying value is the original price of the asset minus the accumulated depreciation. Fair value is the value you can sell the asset for in the open market. Let's look at their current liabilities. $83 million of accounts payable. This is how much money they owe their vendors. $80 million of accrued compensation and benefits. This is how much money they owe their employees. $1.1 billion of current debt. This $1.1 billion is a debt due within 12 months. They owe $1.2 billion on contract liabilities. Of that $1.2 billion, $737 million of deferred revenue. Deferred revenue is when a customer prepays for their Norton product up front. So the company reports that as a liability on their balance sheet. And when the customer uses the product, each month they'll use the product, they'll remove some of this dollar amount off their balance sheet and onto the income statement as revenue. And $470 million as customer deposits. So even though these are liabilities, the company does not owe anybody money. When we looked at the current debt, they actually owe cash on that debt. With this, they don't owe any cash on. With this, they actually receive the cash already. So this is the best liability to have because there's no cash outflow. If you stripped out this liability, they would have positive equity. They owe $20 million on their operating leases in the next 12 months and $400 million of other. Of the $400 million, they owe $117 million to the government, $75 million of other taxes, they owe $69 million in legal fees, they owe $49 million in royalties, and $100 million of other. These dollar amounts are not past due. They just have to pay these within the next 12 months. It's like your credit card bill is due on the 31st, so it's a liability, but you're not past due. You will be past due if you do not pay it by the end of the month. In the trailing 12 months, they generated $1 billion of free cash flow. They have negative $726 million of working capital, and they paid out $291 million of dividend payments. So it looks like they're going to be short $18 million. So they may need to add some debt or equity over the next 12 months unless they generate more free cash flow. The best way to look at ratios is to compare them to companies in the same industry. There are 147 companies in the same industry as Norton, and Norton ranks 20th in terms of market cap. They're at $16 billion. The average is $24 billion. They also pay a higher dividend than the average company. Their price to earnings, price to free cash flow, and price to sales are a lot better than average. Their 3-year annual growth rate is 28%, which is better than average. They have a good ROA of 14%, better than average. And they have negative equity, so we can't look at their ROE. So to summarize, I have them trading at a 26% discount. And this is the type of stock I like. It has a good brand name. The product is easily scalable at a low cost. And it's something everyone needs. Of course, there's always going to be competition. But I think this company and McAfee are kind of controlling the market. And I like that the company got rid of their capital-intensive business and just focusing on their software. I rank their free cash flows, revenue, and ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.